Good golly, folks. You know I love earnings season more than Carl Weezer loves Jimmy's mom. And he loves Jimmy's mom, let me tell you. And who wouldn't? Have you seen her? Anyways, we got earnings season kicking off with a bang, and I hope everyone's excited here. Obviously, even as of today, we had some financials report earnings, but we're talking about next week here, starting the 17th of July. Fantastic. It's my birthday week, folks, so we're hoping for a banger here. We want these stocks to keep going up, baby. Okay. This one, obviously, going to be highlighted mostly with financials, as you'll see here. The vast majority of these will, in fact, be financials. Kind of piggybacking, and normally the first week usually is financials. It just happened to start last Friday. But hey, we're going to continue on and have a great time. You saw some actually pretty darn good results from some of these financials here this morning, and there's some that we're gonna take a look at here as well. I've got three main focus stocks here today that I'm looking at for the week, and other than that, I mean, we're loaded with a bunch of companies here, and I'm sure you're pretty excited about some of them too. I just really have a couple ones that I'm taking a peek at, and I'm sure you probably are too. Starting Monday, not with a focus stock here, but Monday we've got First Bank. That's right, First Bank. Smaller regional banks here, and then we have Cross First Bank as well. That's basically where you just do a bunch of exercises that aren't really exercises, so you can tell everyone you're doing cross first. It's CrossFit. My apologies. Did not mean to get that mixed up. That's my bad. Tuesday, though, we do start off with one that is on my focus list. You want to know why? It's freaking Bank of America, baby. And the reason I chose Bank of America out of all these financials is, well, is the first one to kind of result here that's more in line with something, similar to like, let's say, a Citigroup. And you want to know why? Because Citigroup reported earnings here today, actually, on this Friday. And they weren't necessarily bad, but they weren't necessarily good. And you see, as a result, Bank of America's kind of taken a hit here, too. 1.6% down. Citigroup, the main thing was they slightly missed on an EPS standpoint, and that was one of the big concerns. Whereas you look at other companies that aren't necessarily involved solely in the banking industry and the finance, or simply the banking side of it, with like a JP Morgan who crushed their earnings estimates, right? Crushed them both on a EPS and revenue standpoint. Now, a traditional or more traditional type bank with Citigroup, you end up getting, well, not a great EPS line, and frankly, the revenue is okay. I mean, nothing crazy, nothing to write home about. Slight beat there, but really nothing too crazy there. So Bank of America, it's going to be in a similar line there. Bank of America's really got a similar uh, overall structure of business. Nothing too crazy there. So obviously you got the Merrill Lynch piece of it, which is nice, but I'd say it's gonna be you'll be looking at a pretty similar note there in my eyes. I'm looking for something kind of similar because the majority of their business is going to be here. Now we'll see. Again, I could be wrong, and the reason why this thing's been a stinker, right? The past year, I mean, the 3.2% down isn't too crazy, but then you look in just year to date alone, this thing's down 13%. That's a very poor performance this year, and you see it really has never recovered from really the Silicon Valley Bank nightmare. It's never recovered in price from that point. It's actually still floating right around those levels and hasn't made any sort of improvement because of it. I mean, that's kind of wild to think about. And there's a little more to this business than just the banking, but people aren't acting like it necessarily. So personally, what I'm expecting, look, this company's trading at a ridiculously cheap multiple, and I think they're going to prove it here at the earnings. Already trading at a P/E ratio of 8. 8. 8 price to earnings. What? That's ridiculously cheap. Let's look at the expected earnings. They are expected to grow on a year-over-year basis, which would be pretty nice. They did 84 cents compared to 73 cents a year ago. I think it's a very fair estimate in what I would expect. And from a revenue perspective, 25 billion. That's expected to be a 10% growth. Now, that one I'm curious to see what they do there. I do think because of that Merrill Lynch piece of it too, I think they beat on this aspect. I'd say looking closer 25.25 billion, probably about a $250 million beat Just in my estimation, I could be completely way off on that, but I think they are beating on this line. And look, I think the stock's got a lot of room to move upward because look, it's just not being treated too fairly, all things considered, in my eyes. It's just not. Um, and I don't know why. They just completely hate this stock. The public, they hate it. The investors hate the financials. And I guess there's probably valid reason with what's going on this year. But still, that's why they're one of my focus stocks. I'll be keeping an eye out on them. We've got Novartis after them. Morgan Stanley. Here's where we kind of get into a lot of these ones. Morgan Stanley, I'd expect something similar from JP Morgan's standpoint. I mean, it's going to be similar numbers there. Lockheed Martin, definitely a little bit different. Recent addition to the portfolio with Lockheed Martin. One that's always consistent. Defense spending is always consistent here in this country, and Lockheed Martin is always one of the main suppliers and contractors utilized by the U.S. military. That's why I like them. Very consistent. Nothing flashy with the earnings. Nothing. That's the reason I don't really look at this one for earnings, because it's consistent, right? You're more focused on contract announcements rather than just a quarterly revenue. That's my eyes personally. Prologis after them. A little bit of the Chuck Schwab after them. Charles Schwab reporting. Another stock that's really been in the pits ever since the Silicon Valley banking incident as well. We're talking about a decline of really nearly $30 a share. Really, is right at $30 a share is how much it's declined in the span of, which, just to put that into perspective, it's about 40%. It's pretty significant in terms of a decline. That's quite massive, and obviously they're looking to rebound here, so they'll have to put up a good number. I'll be keeping an eye out there and seeing what happens. PNC Financial Group after them, very similar there to a Bank of America. I'd be looking at them to see what they're able to do. BNY Mellon, really decent watermelon season right now, so I'd expect pretty good earnings here. Synchrony Financial after them. Continue to see credit card runoffs. One of these credit card exclusive companies. Not sure how I feel about them lately because people are really overspending with what they can't afford with these incredibly high interest rates. Obviously, that benefits them from an interest rate payment standpoint, but with credit card runoffs, you see issues there too where people are defaulting on their credit. We'll see. I think there's headwinds and tailwinds right now for a company like Synchrony Financial. It really is. JB Hunt after close on Tuesday. Interactive Brokers, following them. Don't really like their interface too much, but Interactive Brokers are one of those, new up and comings, and people are digging them lately. So we'll see what they're able to do. Pinnacle, following them. Then Hancock Whitney. I definitely would not, make any comment about the first part of that. I would never make a joke. United Community Bank, and then AAR following them. Let me tell you, you don't. This is gonna be random, but I guess you guys don't understand it. I broke my toe a few months back here, and let me tell. I was just feeling this thing. The nail is just still effed. By the way, the thing's black as the night. And it's been about several months, so just curious. Just wanted to let you know that. But anyways, the nail feels really weird at the cuticle. Just thought you wanted to know that. Wednesday before open, ASML, followed by Goldman Eat My Sacks. You know them, you know and love them. Goldman Eat My Sacks. We'll see what they're able to do on their earnings. Obviously, I'll look to Morgan Stanley to see a very similar line there, most likely. Elevance Health. Baker Hughes, U.S. Bank, classic banking here, Halliburton, NASDAQ, M&T Bank, Northern Trust, Citizens Bank, Ally Financial, Commerce Bank. Look at all these banks. They're just going nutty. They're all reporting here. I hope you're excited about these financials. I know you are. Some of you might have added to these positions. These are all stocks that are running way cheap compared to what they used to be. A lot of them trading at super cheap multiples. So definitely a fun week for earnings because you can see these companies come back, right? You can see them pop. You really could. Tesla following them. Now Tesla, look, I had to put it as a highlight stock because it's freaking Tesla, okay? What a shocker. One good thing with Tesla, we always get a nice sneak peek with them on their earnings because of the fact that you already know it. They announce what they did in terms of deliveries for the quarter. They do it early, and it's really nice to see what they're able to do there. So it's good to get a sneak peek, but we still need to look because there's a lot of other things that actually, are attributed to Tesla's earnings as well as their overall revenue. There's more than just the vehicle deliveries. Now, one of the main reasons to highlight it, obviously, is the stock's up 158% this year alone, just year to date, right? On a 1 year standpoint, not really much going on there, but year to date, look at it. 158%. The thing's going to the moon, absolutely. And the only way they can keep that up is from a good earnings report. Now, if you look at expectations, expected 81 cents versus a 76-cent a year ago line. Not great, honestly. Honestly, when you look at a year-over-year standpoint and a full year basis, they're expected to decline EPS. Not too exciting in my eyes. I just, I don't like looking at that. But again, people aren't necessarily invested in Tesla for the earnings. That's not what they're there for. They're not invested for the EPS, right? They're invested in the innovation and what comes for the future. And revenue is a big piece of that. Now, this quarter expected to be at 24.53 billion compared to a year ago 16.9. That's a 45% increase in revenue expected. Now, if they're able to beat this line, let's just be real with each other. If they post a revenue line of 25 billion plus, I think the stock continues to rally. Now, even if they hit near that line and not even, just barely over it, I don't think the investors like that. They're in this thing for a massive growth play, and this is an absolute just swinger of a stock, right? They put a pineapple on their doorstep every day of the week. Elon's got a pineapple out on his doorstep. They're swinging that much. I don't know if anyone got the reference, but that's what I'm focused on. The nice thing about this chair, I'm just telling you, I was laying back during that. I was literally laying down. Hopefully, you weren't able to notice that. I did call myself out though, but that's what you're expecting with Tesla. Look, I'm excited about these earnings because this is a stock that, hey, a lot of people are going to be playing this. There's a lot of implied volatility on it. We'll see what they're able to do on earnings because it's going to jump pretty massively in one way or the other. Now, if this is one where let's say you had a straddle or a strangle on this play, either a call or put on the upper bottom side of even, I'd say hypothetically, if you even do it on, at least 3% on either side, you could probably even do 5% on either side. You likely could end up profitable just because of the swing that's going to be expected here. Now, I will say there's a lot of implied volatility, so you're going to pay a lot for the premiums. So that is worth noting. Anyways, we're moving on to the next one with Netflix. And Netflix is heavily worth highlighting because, first off, year to date up 49%, the last year up 153%. That's pretty significant, but not much on a 5-year standpoint. Really not much. 22% in the last 5 years, which isn't much at all. Now, it's not near the highs it was over $600, right? How is it going to test that? Well, it's close to its 52-week high, so that's something to consider. But the way they're going to test that is this is the quarter in which they started implementing their crackdown on shared logins for different households, I should say. So if you're in a different household, they're going to catch on and say, hey, what the heck are you doing? You got to pay for this. You're in a different house. You can't just use the same membership that this person's using. You're costing us money. And they offered the option to do a cheaper discounted rate if you wanted to add a household to your account. Now, because of that, subscriber numbers are going to be the main focus. How much did they earn? Did they increase subscribers this quarter? While they were forcing customers to use this new system. I think it's going to be a pretty decent number, right? That's the way this stock goes upwards. Now, if it's not what was expected here, let's just be real. I think there's a big chance this stock says it could easily take a doo-doo if the numbers weren't quite what Wall Street's expecting here. But I think the main thing to look at, just being honest here, obviously it will impact revenue, but it's going to be the subscriber numbers more than ever for this quarter, right? We need to know how the new efforts from Netflix in terms of cost cutting and obviously increasing revenue, how are those going to be impacted, right? Are people just going to cut the platform entirely, or are they going to massively increase subscribers? I think the numbers are going to be pretty decent. I can't lie to you. I've heard good reports that the subscriber numbers are looking pretty decent as a result of this move, and really isn't fully necessarily baked in just yet. Now, EPS line expected 284 versus 320. Really not happy about that. Not going to be a great EPS line for him this quarter, but could get better. From a revenue standpoint, really only expected a 3% growth. And I got to be honest with you, that's kind of pitiful, right? You look at the stock, and this is a company trading at a multiple, uh, an incredibly high multiple. Price to earnings of 47 is really expensive for this company, right? A market cap of 196 billion is really expensive too when you think of an annualized revenue of just around 25 billion dollars because it's entirely subscription based. There's not extra revenue that they make here. It's subscription based. So it's consistent every single quarter. They're going to be making the exact same in terms of money, right? So that's kind of crazy. To trade at a high multiple of that nature, it's really, I don't even know how it was prior. It's kind of crazy. So growth is really only driven by subscribers, and that's why that's the main metric to look at. I'm not super excited about the earnings because I think the stock's trading at a ridiculously high level, but again, we'll see what that is. That's Netflix for you. IBM, pretty excited about them too, actually. I think there's a decent play, kind of getting underwhelming results here as far as, you know, as far as what Wall Street's thinking about this one and the investor, they really aren't putting respect on their name, in my opinion. I am curious about IBM before earnings to see what that's able to do as a result. They're definitely a big player in it in an AI industry that they're not necessarily getting credit for. That's just my opinion on the matter. Crown Castle following them. Um, yep, Equifax there. I thought Equifax went under because they were doing illegal things, but they're not apparently. Apparently they didn't. UAL, uh, Rexford Industrial, First Industrial, different companies by the way. One's Rexford, one's First. One came first, the chicken or the egg. Alcoa following them. Now Thursday before open, pretty exciting here. TSMC, that's right. You know them, you know and love them. Big stuff there. Johnson and Johnson reporting. Never a fun company to replay earnings on just because it's Johnson and Johnson. It's incredibly boring. They're very consistent in what they do. Now, American Airlines could be an exciting one. Delta showed very promising results here today or yesterday. Yesterday they reported they showed very promising results with continuing demand for flights, recovery in terms of earnings, and that's very beneficial for these airliners. It really is. Nokia following them. How does Nokia exist? Again, we looked at them too. It's kind of shocking. I just don't know how Nokia exists anymore. Who's buying Nokia products? I can't tell you anyone that is, and I'm falling asleep as we speak. Abbott Laboratories, another pretty boring one, right? You know, these pharmaceutical companies aren't necessarily too exciting to follow for earnings. The way you play these is going to be on, you know, not only just announcements of new drugs, clinical trials, if competitors have, you know, new drugs coming to market, if they're losing patents. Earnings aren't necessarily the most exciting thing for these companies in my eyes. SAP, following by PM. Uh, then we've got Marsh McLennan, Blackstone, Truist, DH Horion. What is that? What I'm thinking of? I don't even want to say that ever again. GPC, and then Thursday after open, we've got none other than Intuitive Surgical, CSX, Capital One Financials following them. That's right. You're going to see none other. You know who's reporting these earnings? It's not going to be the CEO, not going to be the CFO. It's going to be none other than you know who, Samuel L. Jackson. That's right. Not a good one. Not a good joke. Get out of here. PPG. That's just lame. I got to get myself out of here after that garbage that I just said. I freaking sound like Jerry Seinfeld. So just such a lack of humor. WRB. Ocean First Bank. Here it comes with the banks again, baby. Friday before open. American Express, another credit company. I'm looking at Synchrony for kind of a heads up there. Roper. That's what they've always called me that in the bedroom. I've always been referred to as a roper. That's just a fact of the matter, folks. Just letting you know. Schlumberger after them. Regions Bank, Huntington Bank. That's right. IPG, Comerica Bank, and Progressive. Flow is gonna show us some great earnings here. I love flow. I really do. Ladies and gentlemen, with that said, have a great one, and I hope you have a great week.